So the S&P 500, long known as one of the best investments in the stock market, is currently sitting at all-time highs. And since Donald Trump's win in the 2024 election, it has rocketed even more. Year to date, we can see that the S&P 500 is up by over 25%, making it one of the best investments in any ETF over the past year. However, if you are based in the UK, you might be scratching your head wondering which ETF for the S&P 500 you should go into. So in this video, I'm going to compare Vanguard S&P 500 with iShares S&P 500 to hopefully help you in your decision between choosing either one. Now, the platform that I'm going to be using to invest into the S&P 500 is Trading 212, and if you would like to sign up to Trading 212 and receive a free fractional share worth up to £100, you can either click the link in the description down below, or if you've signed up to Trading 212 in the past 10 days and haven't received a free share, all you have to do is to click the 3 horizontal line menu over here. Scroll all the way down until you see the use promo code section, and then enter the code JUBAIR and you should receive a free fractional share. So of course, depending on what broker you use, you don't actually have to use Trading 212. You're going to want to go into the search menu, and if you type in S&P 500, you'll see that there are a lot of different companies that do offer the S&P 500. Now, the most popular by far in the UK is this fund over here called the VUSA, the Vanguard S&P 500. And what I first want to do before comparing the two is to explain the differences between DIST, as you can see in the brackets over here, or ACC. Now, here is the Vanguard S&P 500. As you can see, this is a distributing fund. The stock market is still open right now, as you can see highlighted by the green dot here, which means that the price of the fund will still bounce around until it closes. But in either case, the difference between distributing, which is DIST, or accumulating, is that when you hold a distributing fund, dividends will be paid out to you as cash instead of being reaccumulated back into the fund. Now, essentially, the S&P 500 is a collection of the top 500 companies in the US. Sometimes it's a bit more than 500, but essentially 500. A lot of these companies will pay out dividends, and of course, if you're investing into them, you will also receive the dividend. The fund receives the dividend and then chooses to either give it out as cash or to automatically reinvest it back into the fund. As you can see here, the same fund, but this is an accumulating version, the VUAG here. And essentially what Vanguard does here is, by creating the ETF, they take it upon themselves to invest into these 500 companies, create a large fund, and then share it out to people as shares. As you can see, per share currently costs around £87. When you buy that, you get a share of the entire fund. And then it is up to you as a shareholder to decide if you want the accumulating version, which Vanguard will reinvest all those dividends back into the fund, or if you want the distributing version. So now that we understand the difference between distributing and accumulating, let's understand the difference between Vanguard funds and iShares fund. Now, like we've seen in the beginning, this is the actual index that it is all based on. If you go into Google and type in S&P 500, you'll see that it is in points. Essentially, an index will be in points because the currency is actually a factor that changes depending on where you are. In the US, of course, all these companies are based in dollars, so the actual Americans will buy and sell them in dollars. So what Vanguard will have to do is to create a fund and then denominate that into pounds, in which UK investors can buy in pounds instead of dollars. Because of course, if you buy it in a different currency, you're going to be paying foreign exchange fees. So in this video, we're just going to be looking at the typical S&P 500 ETFs, nothing thematic. For example, there is an iShares one, which actually just involves investing into IT related ones. Now, this would have a higher return because it actually excludes a lot of the companies that are not IT, which also means you're getting less diversification. Right now, IT companies are doing really well, but they might not always be doing well. So for the purpose of this video, we're not going to be looking at, specific variants of the S&P 500. Now, if you are going to go for Vanguard, these are the two main ones, the VUSA and the VUAG. They pretty much track the S&P 500 like it is in the US, but they offer a pound version for it. So the difference between the US returns and the UK returns with Vanguard will be affected by currency differences between the pound and the dollar. That is why most of the time it will not be 1-to-1 with the original index, as the index is based in dollars and Vanguard offers it as pounds. So when comparing between different fund managers, example Vanguard or iShares, it is important to notice a few differences. The first is the cost of running the fund, or the total expense ratio, and the other would be the actual holdings, because between fund managers the holdings can be slightly different. Another key difference might be looking at the past performance. So over the past year, the Vanguard S&P 500 distributing has returned investors 30.2%. Now this would be the iShares equivalent of the Vanguard S&P 500, the VUSA. This is the iShares Core S&P 500 distributing fund, and as you can see, it is in pence, so we're not paying that foreign exchange fee. And over the past year, it has returned investors 30.26%, which is almost identical to the Vanguard USA, if not just a bit higher. But you also have to take into consideration that the dividend yield might be slightly lower than the Vanguard USA. So there's so many different considerations that you must make as an individual investor. So this is the Vanguard S&P 500 accumulating version of VUAG, and over the past year, it has returned investors 31.7%. Of course, it's higher than the VUSA because the dividends are automatically reinvested back into the fund. Now here is the iShares equivalent of the VUAG, which is the CSP1, which is the iShares Core S&P 500 accumulating version. So as you can see, this is in pence. The cost of the fund actually doesn't matter. It is the return percentage wise that matters. And over the past year, this fund has returned investors 31.55%, which again is just splitting hairs with the Vanguard version. You're not going to get, in my opinion, much of a huge return between the two. At the end of the day, it really does boil down to personal preference, or if you look at what kind of holdings these funds hold. So for the purposes of this video, I'm going to compare the Vanguard's most popular one, Vanguard S&P 500 VUSA, with the iShares most popular one, which is the IUSA. Now on Trading 212, you can already receive a lot of information about the iShares fund built in. So we're going to use that as the basis of a comparison. So as you can see, one of the most important bits about any ETF is the expense ratio, or the ongoing fee. And this is a fee that allows the creator, iShares or Vanguard, to actually carry out the fund, because of course it costs money to maintain all that infrastructure. And 0.07% is actually pretty low. It's very hard to actually beat that in the UK, so it's not a big deal here. Other important things will be assets under management. So this fund actually holds 13 billion plus pounds, which is a big fund, and bigger funds are generally less likely to fail as more people's money is in that. Now also the dividend yield here is 1.07%, so we can compare that too, and the dividend payout frequency is quarterly, so 4 times a year. Now like I said, one of the most important things is the asset allocation. Every company might slightly change around the asset allocation of the S&P 500. For example, with iShares S&P 500, you're getting 7.03% in Apple, 6.65% in Microsoft, 6.55% in Nvidia, 3.47% in Amazon, and so on and so forth. You can check it out for yourself. Even small variance percentage wise in these companies can often make, a noticeable difference in the return of a fund. As you can see, many of these companies at the top, Apple, Microsoft, and Nvidia, are trillion-dollar companies, multi-trillion dollars in some cases. So even a small percentage could make a big difference. Now, the next important thing will be sectors. Of course, we already know that the S&P 500 is very technology heavy focused. As you can see, 31.62% in technology, 12.87% in financials, 12.05% in healthcare, and so on and so forth. Now, without surprise, it is pretty much 100% based in the United States of America. Some of it will be based in Ireland or other countries, but the S&P 500 is pretty much 100% USA, so that I would not worry about there. Now, in order to find out information from the Vanguard USA, I'm going to have to use a third party, so I apologize for that. I'm going to use Hargreaves Lansdown, which at the end of the day isn't the worst platform ever, but I do believe Trading 212 beats it by fees by a whole amount. But anyway, as you can see, this is the VUSA, the Vanguard USA, and the first thing we notice is that the dividend yield is a bit lower than the one in the IUSA. Again, not a big deal here. The assets under management, if I am reading this correctly, is actually bigger too, at 5.8 billion. Again, hopefully I'm reading this correctly. The VUSA is definitely bigger than the IUSA from iShares. As you can see, the names are very similar because they are intended for the same audience. Now, as you can see, the ongoing charge is 0.07%, which is the same. Don't worry about management fees here, because on Trading 212, you don't have to pay management fees. This is just because I'm watching this on Hargreaves Lansdown. But in either case, you can see the percentage amounts are a little bit different. Apple is 7.27%, Microsoft 6.57%, Nvidia 6.13%, and Amazon 3.57%. If you're wondering what the holdings mean, essentially out of per £100 like to invest, $7.27 will be in Apple, $6.57 will be in Microsoft. It's just a percentage amount of weighting that these companies have in the index. Now, in terms of sectors, I wouldn't worry too much about this because, each company, each platform will, categorize sectors a bit differently, so I wouldn't worry too much about that. But of course, we know the S&P 500 is weighted very heavily towards IT. And again, countries, I wouldn't worry too much about that. Pretty much 100% in the USA. And as I said before, Ireland would be a very high amount. And then other places like Switzerland, Netherlands, that's a lot to do with the management of the companies and the funds. Nothing to worry about there. So like I've said in previous videos, I don't believe there are huge differences between the Vanguard and the iShares funds. It is always personal preference. I'm never giving financial advice. Do your own research, and whichever one you like more based on the holdings or based on other small factors, you can go with that. However, when it comes to iShares, I particularly like this specific ETF, the GSPX, the iShares Core S&P 500. Now, as you can see, over the past year, this has returned investors 35.78%, as opposed to the VUSA, which has returned investors only 30.14%. So as you can see, this has significantly outperformed the other funds we compared to today. And the reason for the difference in this performance is the fact that this particular fund, again, it's denominated in pounds, so you're not paying dollars. This fund is actually hedged, so the currency differences between the pound and the dollar, they are minimized. As you can see, this comes with a cost. It is 30% more expensive, with an expense ratio of 0.1%. And again, the holdings might be slightly different, with Apple at 7.05%, Microsoft at 6.65%, and so on and so forth. But of course, the main difference is that the currency is hedged, so you are basically getting more of a 1-to-1 with the actual American index that we saw before. So make sure to check out some of my other videos, and I'll see you in the next video.